Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 that has been absolutely tanking over the past couple of days. We had Jerome Powell speak on Thursday right here as the market was testing an important resistance level. It rejected, and we've seen massive downside ever since. People are very concerned about this market. We have some of the lowest sentiment readings in history, with around 15% of market participants being bullish on the market right now. And we have indicators like the put-call ratio, the equity put-call ratio spiking, highlighting an extreme sense of bearishness in the market right now. So we're going to talk about all of that. We're going to try and make sense of all of this data, what this move means for the SP 500. Is it breaking down any important technical structures? And what should we expect for the rest of this week and the weeks to come? If you're interested in following these crazy markets with us, make sure to smash that subscribe button as hard as you can. If you enjoy this episode, if you appreciate the effort and time that goes into making this research and putting it out for you guys, make sure to smash that like button. And now, without further ado, let's get right into it. Now, let's begin with the technical aspects of this SP 500 correction here and see if it's really something that was unexpected or something that was entirely possible the entire time. If we go back to one of the articles that we posted on gameoftrades.net on the 31st of March of 2022, we had a bullish macro thesis. But if we zoom down to the short-term picture of the SP 500, we took a look at this chart of the volatility of the SP 500. This is the VIX. So when volatility expands, when it goes up like it did here during March 2020 during the COVID crash, that means the market is going down. And so when the VIX tops, that usually corresponds to a bottom on the SP 500. So you can see ever since that COVID crash, we've seen volatility decline with the market that's obviously been trending up. But now if we zoom into what's been happening for the last few months here, ever since November, let me zoom in, ever since November where tightening was announced, the Federal Reserve started to get hawkish, talk about hiking rates. We've had this expansion in volatility and this nice trend line that was respected the entire time. And you can see again, this is on the 31st of March. The market was testing that line of support on the VIX. Let's press that play button and we can take a look at what happened to volatility since then. You can see we had a bounce and then another spike since Jerome Powell spoke. Now, this is just a reminder. If you're trying to trade short-term price action on the SP 500, you don't buy the SP 500 when it's testing the VIX support trend line. You buy it when it's at resistance, testing big levels of resistance. So let's check out what's going on the VIX right now. I made this chart a lot more simple so that we can just take a look at two important levels here. So we have that trend line here that we bounced off, and I want you to pay attention to this line here, to this horizontal resistance on the VIX around the 35 to 36 resistance level. That is major support. It systematically corresponds to bottoms on the SP 500. Let me add the SP 500 on this chart. You can see every time it hits that resistance on the VIX on 35, it's a buying opportunity. That's been the case even throughout this correction, right? These were buying opportunities on the VIX. And we can zoom out earlier and you can see it rarely goes much further up than 35. Even the bottom of the 2018 correction here, which was a 20% correction, that was ended with a VIX spike to 35. We can zoom out even further. All big corrections end with the VIX around that level. The only two exceptions we've had since the 1990s is really 2008 here and COVID-19, where the VIX spiked massively higher. I'm not saying that can't happen again, but right now that's not what we're anticipating. You can see the VIX right now is at 29, so that's a little bit under that 35 level. We could have a little bit more volatility and spike to test that level. But what I'm really paying attention on this chart here is this line here. I'm going to show you this trend line resistance that we can draw from that top of volatility at the COVID low. And we now have a nice reaction here in January and in March 2022. So far volatility is being contained by this resistance on the VIX. I want to see and watch what happens with the VIX when we get there. I think there's going to be buying power over here. So that's something to watch over the next couple of days. Right here, we had a massive spike in the VIX in 2018, and we can draw a similar type of line here of resistance that really contains the volatility every time the VIX tests that line, right? Volatility sellers come into the market right here that pushes the SP 500 higher. So from a technical standpoint, we haven't seen anything that's wildly out of our expectations. That article, we highlighted a few levels that we could go back to in the event of a correction on the SP 500 were the levels we were looking at. Let's press that play button to see how they acted as support. And you can see these levels here acted as support, but since Jerome Powell spoke, we just cut through all of them like a hot knife through butter. So that's perhaps one worrying sign. I'm going to discuss a couple of worrying signs in this video, but try and nuance them with a more complete picture of everything that's going on. But I do think we have to be realistic with our expectations, at least for the short term. Worrying development would be the power of this move that we're seeing here. I would have preferred to see slowing momentum on this move as we're getting to that support level. What we're seeing here is an acceleration of that move down. Very subjective. It doesn't really mean anything. Very often, big lows on the S&P 500 are made with big candles, like here in September and back here in 2022. Big lows are made with big candles because that's when you have that type of capitulation. I can show you a beautiful example of that, for example, right here in October. Let's replay and see how that looked like back here. I don't know if you were trading back here, but that was a scary candle on the S&P 500. If you were watching this trend line here, you would have seen a nice breakdown with a close under it. That's a scary development that's meant to shake out weak hands. Obviously, the market's bottomed from there and rallied significantly. So why is this happening? Let's get to the root cause of why we're seeing this volatility, why there's such a panic move here since Jerome Powell spoke on Thursday. If you take a look at that 8-hour chart, that's a big false breakout. So the market was breaking out just before his interview. And then during that interview, he spoke about the markets and about being very hawkish. And obviously the market reacted very badly. And I'm going to show you why here. This is on cmegroup.com. And this is a Fed watch tool that gives you the target rate probability. So what the market is currently pricing in for the Federal Reserve's target rate. And basically this is the June 2022 probability. And what changed since Powell spoke on Thursday is that now the market is pricing an 87% chance that the target rate is going to be between 150 and 175 basis points between now and June. We're currently at a 25 basis point interest rate. In order to get to 150 basis points, we need a total of 5 rate hikes, 5 25 basis point rate hikes. That means 2 in May and 3 in June. That is absolutely massive. That's absolutely crazy. And that is why the market is seeing a lot of volatility right now. So it is just more of the same. It is the market pricing in rate hikes, discounting those rate hikes. And so that triggers volatility on the markets. I have to admit that it's lasting longer than I had anticipated. I thought that the market would be done pricing in rate hikes by now. One thing I am watching is the 2-year yield. Why am I watching the 2-year yield? Let's zoom out on this chart, go to a weekly chart and add the Fed funds rate. You can see the 2-year just leads the Fed funds rate, right? The Fed basically follows the 2-year yield. Jeffrey Gundlach says this a lot. The Fed basically just follows the 2-year yield, and I 100% agree with that. It couldn't be more clear from this chart. And so let's zoom in. You can see around in November here, that's when the 2-year really started to spike. And guess what the Fed did? They started to get hawkish and talk about rate hikes. So if we start to see the 2-year roll over here, that's when you know that market anticipation of rate hikes are starting to go down, and that's going to be good for the market. It seems like it's starting to happen here. It seems like it wants to roll over. Again, I already expected this to be a rollover in April, so I have been a little bit early on this reversal, but I think we're very close to seeing that trend roll over. And once that's the case, these target rate hike probabilities are going to stop increasing, and so you're not going to see as much unexpected volatility on the S&P 500 like we've seen throughout this period. Now let's quickly talk about technical structures that I'm watching right now. Now, if you've been following this channel for the past couple of years, especially throughout 2021, we've had this price channel throughout this entire time that really captures major resistance levels on the S&P 500. It helped us really time those market tops and bottoms really throughout the entire time. If we copy and paste that trend line, we know that the market loves symmetry. It likes parallel price channels, and you can see if we put this line here at the COVID low to get that reaction, it really marks the bottom of this correction, and you can see we're currently testing that level again. So ideally in this correction, I want this level to hold. If it doesn't, we start to really break bullish technical structures. If we don't hold this level, we also have this head and shoulder pattern that is invalidated, and so that could begin to delay a durable rally. If we start to get these types of breakdowns, we could revisit that previous low before we see any type of shift in the momentum. One more concerning development that I wanted to show you guys is this chart here, the XLP divided by SPX. Now, XLP is consumer staples. It's the defensive sector, and we talked about this a couple of times, especially with our members on gameoftrades.net. This has been one of the things that we've been watching out for to know whether we should watch out for a durable bottom on the S&P 500. The ratio throughout a few weeks was testing resistance here, big level of resistance that corresponds to major reactions here. But over the past week, we saw a breakout here, an impulsive breakout out of a head and shoulder type of structure that could take us much higher. So when I see the defensive sector breaking out, it keeps my mind open to the possibility of a little bit more short-term volatility. If this ratio all of a sudden decides to reject here, that's going to be massively bullish. In fact, one last chart that I want to show you guys, hopefully putting all of this into additional context. There's many pieces to this puzzle that we have to put together to get that complete picture and differentiate between what's going on in the short term, intermediate term, longer term. Are we oversold, overbought? This is a chart of the NASDAQ 100 stocks above their 200-day moving average, right? This is the breadth. We often take a look at this because it is just a beautiful market timer. When you have the market breadth at around that 15% level, it historically is a major buying opportunity for the tech sector and for the market in general. Back in March here, we fell just shy of that 15% reading. So if we do have a breakdown here and see additional volatility, could we see a move down to 15% before we get a big bottom in the market? That's possible. And that would very likely mean undercutting by a slight margin the March low on the tech sector. So I know there's a lot of information to process in this video, so I do want to make a quick conclusion. I think there is still a very solid bullish case forming for the equity markets, where a lot of the headwinds that we saw since November 2021 will dissipate, and that's going to remove a lot of the selling we've had. A lot of the indicators we're looking at are saying that a bottom is very close. If we didn't print the low in March, then we might get a slight undercut of that low. A lot of the short-term indicators like the VIX that we're watching and the short-term market breadth are telling us that, we could see a little bit more volatility, a little bit more pain before that weekly momentum really begins to flip. So I hope you guys enjoyed this video. If you did, make sure to leave a like to let us know. Make sure to leave a comment down below to let us know what you think. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. Now, in the meantime, I wish you good luck on your trading and see you next time.